course, I'm here to show you about stock market updates and today's account performance. Today, the U.S. stocks closed mixed, and SQQ closed up 0.55% to 19.98, and United Natural Gas closed down 2.73%. Right now, the net asset of my account is 69,593.19. Today, Dow Jones Industrial Average closed lower to 0.51%, Nasdaq Composite closed up 0.06%, and S&P 500 closed down 0.28%. Today, the auto manufacturers closed up with a gain of more than 3.5%, whereas semiconductors closed down 1.59%. The market is still waiting for NVIDIA's financial report. Wall Street held discussion after the after the August curves. Where will the U.S. stock market go? S&P 500 is up 21% over the past 7 months, but as Wall Street lowered its forecast for the U.S. recession and the investors flocked into the market, but the stocks have turned around and fallen over the past 3 weeks, with the benchmark index down about 5%. However, for Wall Street professionals, a weak performance of the U.S. stocks this month may not come as a surprise. According to Stock Trader's Almanac, history tells us that August has been the second worst performing month for the U.S. stocks for more than 30 years, and it was especially bad the year before the presidential election, hence the August curse. However, the problem this August is not just about seasonality. On top of the pessimistic growth historical trend, bond yields are soaring. The 10-year Treasury yields are now at its highest level since about 2007, jumped nearly 10 basis points on Monday and to well above 4.3% after hitting a low about 3.68% in April as investors delayed expectations of a Fed rate cut. Recalling that stocks, especially high-growth tech stocks, are vulnerable during the periods of rising interest rates because higher borrowing costs reduce profitability, while higher yield bonds mean investors can earn good returns from investments that are safer than stocks. Coupled with Fitch downgrade of U.S. debt and the still uncertain inflation outlook, the current downturn in the U.S. stocks seems to be no surprise. Goldman Sachs, the bank strategist, reiterated that the S&P 500 year-end target of 4,700 points, about 8% above the current levels, as he saw no reason to worry about the August plunge. Goldman Sachs said investors still have room to increase their exposure to equities as the likelihood of a recession declines, and the retail activity should increase in the coming weeks as the short-term traders turn bullish. Meanwhile, Goldman Sachs expects a significant increase in share buyback as the second quarter earnings season ends. JP Morgan strategists wrote in a note that U.S. consumers have spent their excessive savings from the pandemic, which means they have less money to put into the stock market. As a result, it looks set for further declines. Marko Kolanovic, chief global market strategist, ultimately expects the S&P 500 to close the year at 4,200, down about 4.4% from current levels. Morgan Stanley analyst at Morgan Stanley Wealth Management noted in an August report that soaring yields were the reason investors chose bonds over stocks. Chief investment officer Lisa Shaw said fixed income assets are good hedge against downside risk in equities. In a scenario where perfect soft landing shows signs of vulnerability, investors may want to allocate cash inflows to U.S. Treasuries, with coupons ranging from 4.5% to 5.5%, with substantial capital gains potential, she wrote. Fonstrat Global Advisors, an American investment institution, suggested that investors should expect a rally in stocks this week, thanks to two catalysts: the Jackson Hole annual meeting, Powell's speech, and NVIDIA's upcoming earnings report. After August, Lee predicted that S&P 500 would hit a record high of 4,825 points this year. And last week, he said investors should see the recent sell-off as an opportunity to buy dips. We think it is more likely that the August curve ends this year, the start of a larger decline. He said, "We don't think the market outlook will change until the end of 2023. In fact, this will ultimately prove to be an excellent buying opportunity." Investment bank Stifel said A strong rally in equities this year is over, and investors should prepare for low returns for the rest of the year. According to him, a recession is still possible in the first quarter of 2024. He expects S&P 500 to close at 4,400 by the end of the year, close to the current levels. That's all we have for today. Thank you for listening. Don't forget to subscribe and see you next episode.